My favorite option trading strategy is the wheel strategy. Now, I love the wheel strategy because it's very easy to comprehend. It's just a system of selling cash secured puts and covered calls, and it generates consistent, repeatable profits, but there are some mistakes you can make trading the wheel, some big mistakes you can make trading the wheel. So today I wanted to cover 4 mistakes that you need to avoid if you're trading the wheel strategy. By far, the number one mistake most wheel traders make is they just pick the wrong stocks. They pick bad stocks to trade the wheel strategy on. For one thing, you don't want to ever try to run the wheel on a underlying stock that hasn't seen an uptick in months, or in some cases years. I see way too many wheel traders on the internet, and in some cases even like YouTube influencers, financial influencers that trade the wheel strategy. I see some of the underlying assets that these guys are trying to run the wheel on, and they're losing money sometimes on camera, and they seem confused about why they're having a bad time. A lot of it has to do with just picking garbage companies, garbage stocks to run the wheel on. Make sure that that thing actually has a long track record of being a profitable company that tends to go up in share price over time. And this isn't hard to do. It's not rocket science. All you got to do is take a look at a chart, right? I mean, it's not terribly complicated. If I go to my trading platform here, this is TASTYTRADE. Let's take a look at a few ticker symbols. Here's the chart for Apple. Apple, this is a daily chart of the last year or so. You can see Apple tends to mostly go up or trade sideways. Apple, I'd be fine running the wheel on a stock like Apple. What about Amazon? Oh, wow. Amazon. Look at this chart. Now, this is the perfect chart for, running the wheel, like something that really just hasn't seen a downtick in a long time. It just tends to go up. I'd be fine running the wheel on something like Amazon. How about Google? Let's take a look at the Google chart. Google also has had a very big run up here in the last year, but all these stocks too, if you go back further than a year, multiple years, Apple, Amazon, Google, they are pretty much near all-time highs. They're really big driving forces in the overall market. They're big components to index products like SPY and QQQ, which are the S&P 500 and the NASDAQ, right? They really drive the market. And of course, the markets right now are very strong, and partly because these major trillion-dollar companies are very strong right now. What about some weaker products? How about PFE, which is Pfizer, which is a pharmaceutical company. Pharmaceutical companies had a really good year during the COVID year because, of course, the vaccines helped promote a lot of sales. But since then, they've come crashing back down to earth. You can see here in the last year, Pfizer has done nothing but go down from, around $44 to trading at $26 as of today. And it's really at about all-time lows, really. So is this a good wheel strategy stock? Absolutely not. I would never sell a naked put in Pfizer with the plan of accepting shares, being assigned shares, right? I don't mind selling a put on a product like Pfizer if I'm doing it because I'm a contrarian and I think this thing will eventually go back up, but I'm not accepting shares, right? If I have to, I'll take a loss, we'll settle it for cash, but I'm not selling a put with the plans of being assigned shares and holding those shares, because this thing could keep going down, right? This thing could be $15 in the next year, or it could be $5 in the next year. It could be $0. It could go bankrupt here in the next couple of years. Who knows? I don't want to be holding long shares of stock on something that looks like it is basically heading toward bankruptcy. Let me pick a few other ticker symbols that I know, these are popular trading vehicles. Pfizer, a lot of people trade it. Well, WBA, which is Walgreens Boots Alliance, which is, your pharmacies, right? Walgreens has been in a lot of trouble for a number of years. You can see it just tends to go down. Right now, it's trading all the way down at $17.94. This thing used to trade much higher. If I go back a couple of years, you can see it was, $60 just a couple of years ago. So this thing has really just tanked in share price. Would I ever try to wheel WBA, Walgreens Boots Alliance? Absolutely not. But I see people do it. This is one that I picked purposely because I see a lot of people that trade Walgreens. It's got a lot of volume. You can see it trades more than 7 million shares traded today. The options, it's got weekly options, and it's got decent markets, 10-cent wide markets as far as the options markets. But just because, it's liquid, which you want liquid products. That's the number one rule, is actually you want to trade liquid products, but you also want to pick the right strategies for the right underlyings. And this underlying is definitely not one that you want to be placing a very bullish trade on, such as selling a cash secured put with the intention of eventually being assigned shares, right? I don't ever want to hold shares of Walgreens. And if we want some more extreme examples, I can just pull up some names that I know are, barely tradable these days, but this was a very popular company in years past, or really in decades past, BlackBerry, right? Anybody remember the old BlackBerry devices, mobile devices? Well, right now, BlackBerry is trading all the way down at $3.05, and this is another stock that used to trade much, much higher. You can see it was, like a $20 stock just a couple of years ago if I scale all the way back. But you can see BlackBerry, that's not a good chart. That is not a healthy chart as far as a bullish chart. Don't run the wheel on garbage company. That's the number one thing. And that really is what kills so many options traders, is just you're running the wrong strategies on the wrong kinds of stocks. The second huge mistake that many wheel traders make is they collect too little credit for the options that they sell. And this is just a killer, because when you're selling options, when you're selling your cash secured puts and your covered calls, you got to make sure that those short options have some premium to them. It's not worth it to sell options unless you're getting paid for taking that risk. So let me go back to the trading platform. Let's pull up a options chain for Google. I'm going to go out to the 35 DTE options chain. For me, I typically like selling my puts between 16 deltas and 30 deltas. Typically, I'll go out to 16 deltas if I can get a decent enough credit for it. So right now, this 140 strike put is 14 deltas. That's close enough to 16 deltas. I'd receive $1.34 credit for selling that put. That's actually pretty decent credit for being all the way out at 14 deltas on a product this size. But right now, IV rank in Google is 95. That is extremely high IV rank, which means I can really go out far, as far out of the money as I want to go and still get a decent premium. Now, if I didn't think $1.34 was decent premium, then I could bring that in to, I might go around the 30 delta mark, where I'd get, a $3.50 credit on a buying power reduction of only $2,400. So that's actually a really nice option too. Either one of those options would be really nice. But sometimes you see people that don't want to take the risk of selling, a 30 delta put, because a 30 delta put is going to win 70% of the time. It's going to lose 30% of the time. 30% of the time, you might be faced with a situation where you either take it off for a loss or you accept assignment of shares. With a 16 delta put, or in this case, a 14 delta put, I'm going to win about 86% of the time. I'm going to lose 14% of the time on that. But still, a lot of people really want to avoid losing, and especially with the wheel trade, they want to avoid assignment at all costs. So they might do something really dumb, like sell a 6 delta put, right? Now, yes, you're going to win like 94% of the time, right? You're going to only lose 6% of the time, but you're not getting paid for selling that put. You're only getting paid 53 cents for selling this 6 delta put. Is that worth it? I mean, no. In my opinion, it's not. And the reason it's not worth it is you're going to be assigned. You're going to lose on some of your short option positions. Sometimes it's unavoidable. Big outlier moves will happen. They just do. You're going to face a few of those crazy moves, like 3 or 4 a year. You're going to see one of these big moves where a stock will drop, 10, 15, 20% in a day or in a week or whatever it happens to be. It'll make some crazy move against you. You can't avoid that. It didn't matter if I sold the 30 delta put, the 20 delta put, or the 5 delta put. A 20% drop of a stock is going to blow past all of those strikes. You can't get far enough out of the money to avoid a move like that. But the thing is, if I'm selling something like a 20 delta put or a 30 delta put, at least I was collecting some decent premiums, some juicy credits along the way before I faced a situation like that. If all you're ever doing, and if you're doing this repeatedly, especially, this is a killer for your account. If all you're ever doing is selling these really low premium puts and calls, you're not collecting hardly any money. And then when the big outlier moves that are going to catch everybody anyway do happen, you really weren't collecting a lot of money to begin with along the way. At least I was stacking some cash along the way if I was selling those 30 Delta puts, right? Where you really didn't stack any cash. And then now you're facing a big loss that pretty much is going to wipe out all of those small gains that you acquired along the way. So the big thing to consider with collecting enough premium is make sure that you're picking a delta that's reasonable. I like again 16 to 30 deltas. That's my area, that's my zone that I like to play in. The other thing is make sure that the underlyings that you're selling your puts on especially have high IVR, high implied volatility rank. Typically you want an IVR above 50, but really 30 and above is acceptable. As long as I see an IVR of at least 30, I'll still sell a put on it. But anything below 30, that's just too low. It's going to be, the premiums there are not going to be very rich, and you're going to find better opportunities somewhere else. And mistake number 3 that I see way too many wheel traders make is they lock in losses unnecessarily. And when I say they're locking in losses unnecessarily, I mean they're taking losses that they didn't have to take. Right? Because this typically happens in 3 different ways. When you lock in these losses unnecessarily, typically they're because you either are not rolling, or you're not taking assignment when it makes sense to take assignment, or on the covered call portion of the wheel trade, what you're doing is you're selling covered calls below your cost basis, which is most of the time a mistake. For example, if your cost basis per share is $100, so your long shares of stock, your cost basis on that right now are $100, but you're selling a call for $98 for a 98 strike. Well, what happens when you get assigned on that call? You have to sell your shares at $98 a share, but your cost basis is $100 per share. So when you sold that call, you were already kind of locking in a $200 loss on that call, if it got assigned. So, don't do that. Don't make these, kind of silly mistakes. Not rolling is a real silly mistake because honestly, most of the time you're not facing like big losses, right? So you sell a put and say a few weeks go by, say 3 weeks goes by, you get to 21 DTE and you're deciding to manage it at 21 DTE, meaning you're either going to close it for a winner or a loser, or you're going to roll it. And at 21 DTE, you look at it, it's a small loser. Should I just take it off, take that small loss? Well, you could just roll it out to the next month and not take any loss, right? Just give yourself more time. Plus, chances are, if it's only a small loser, you'll also receive additional premium to roll it out further out in time. It's just, it doesn't make any sense not to roll when you can. And as far as not taking assignment on shares when it makes sense to do so, if you went into the trade with the plan of running the wheel, meaning in your mind, before you ever place the trade, you already mentally prepared yourself, I'm going to take 100 shares of this stock if necessary, if it gets assigned. But then a couple weeks later, the trade goes against you or whatever, and you decide to close the trade for a loss for cash rather than holding it till expiration to see if you get assigned. Maybe you do, maybe you don't. That's the thing. You may not even get assigned if you hold it all the way to expiration. At that point, just see what happens, right? And even if you do get assigned, again, you plan on it. So what are you doing, right? If you went into it with the plan of taking assignment, stick to the plan. And mistake number 4 is one that all traders need to avoid, not just options traders, but stock traders, futures traders, whatever it happens to be, and that is trading too big. When you trade too big, you're just taking too much risk. And when you take too much risk, mentally, it breaks you down and it makes you do dumb things. Like a lot of the mistakes I've already talked about, like locking in losses and not rolling, not taking assignment if you plan on taking assignment, selling covered calls below your cost base. And, a lot of these mistakes we've already covered. A lot of times people are doing that is because they were trading too big in the first place. And because they were trading too big, they had too much risk on the table. And now they've got to make these less than ideal decisions in their trading because really they should have never been trading that large position in the first place. If I go back to my trading platform here, you can see Google right now. If I sell a 14 Delta put in Google, I need a buying power reduction of just $1,400, right? So that's comfortable, right? If I had an account size of $25,000, that would be an okay buying power reduction for that. $25,000, not a very large account. I got to take a little risk, and I am taking a little risk by having a buying power reduction of $1,400. But that would be okay, I guess. But what if instead I was doing a high price product like Netflix? And then I go to the options chain, let me sell a 14 delta put on Netflix. Now my buying power reduction on that is $5,300. And I have an account size of $25,000. That is 20% of my account is already tied up in one trade. And that's right now. What if the trade starts going against me? What if Netflix starts dropping in price and it starts getting closer to my short put? Well, what's going to happen is my buying power reduction is also going to increase because it starts becoming much more likely that I will get assigned on this, meaning the buying power reduction could all of a sudden become $6,000. Or $7,000 or $8,000, it'll become a much bigger chunk of my small account size. I can't do that. You have to avoid trading these kinds of big products or taking these really large positions, whether it's a large product or not. Sometimes you take too big of a position size for something, and you can't really trade it effectively because you're just too scared of the risk. And while we're on the subject of not trading too big, many people, when they first put on a position, they'll properly size it. It's not too big for their account. They went into it with the right position size, but then that position becomes a loser. Then they want to double down on the position. And this is where things can get way out of hand. A common strategy with stock and holding shares of stock, which you might be doing when you're running the wheel strategy, is averaging down after the stock drops. Say you buy 100 shares of a stock at $100 per share. So it was trading at $100 per share, but say it drops 20% over the next few days or few weeks, all the way down to $80 per share. Well, now you're down 20% if you're holding those shares that you bought at 100. But what you could do, you could average down. This is what a lot of traders do. They'll average down. They'll buy another one lot, which is another 100 shares at the new $80 price. Now they have 200 shares of the stock, but now their average cost per share is only $90. So instead of holding 100 shares at $100 for their cost basis, now they own 200 shares and their cost basis is only $90. And while this does make sense, you just reduced your cost basis by $10, right? By averaging down, you just cut that cost basis in half when you average down. But you know what also you did? You also just doubled your position size, which means if initially you put on the trade around the maximum amount of, as far as a percentage of your account value that you wanted to be in the trade at, well, now you just blew way past it when you decided to average down. Do not average down. The only time you should ever consider averaging down and buying more shares is if, for whatever reason, when you put on the trade, you went into it thinking, well, I'll average down if it goes against me. And what you did is you didn't put on your full position size in the beginning. So there you have it. 4 mistakes to avoid as a wheel options trader. Once again, those mistakes are picking bad stocks, collecting too little premium, locking in losses unnecessarily, and trading too big. Now, if you want to learn more about options trading and especially the wheel strategy, check out my book, The Super Wheel Options Strategy. This book is available in paperback, hardback, and Kindle edition over on Amazon. There is a link to that book in the show description. Peace, guys.